Hello and welcome to Options Guide TV. My name is Brian Overby. I am the author of The Options Playbook, and I will be your host. We're going to be quick this week, or this day, I should say, about 20 minutes, because we're just going to review a few trades. I'm sad about my Amazon trade, but if you did put the trade together, and after Microsoft's earnings and what they said about the cloud, you should have never rode that trade into earnings, mainly because you got paid, but without the risk. So I want to talk a little bit about that. But we were about, out of our earnings trades, we were like 6 for 6. And I really wanted to do the skip strike butterfly in Amazon, but it just wouldn't pay us. It just wouldn't give us big enough of a credit, and that was the right trade. Okay, so I'm all befuddled about the Amazon trade. It really annoys me because they had really good numbers. It basically went down because of the conference call afterwards about earnings, or I should say that earnings call just in general. And some of the things that Andy Jassy said, they just kind of got a little bit, I don't know, taken the wrong way from what I can ascertain. And the market is punishing Amazon for it. But I look at this, if you don't own Amazon, you want to get long, this is a buying opportunity. There's nothing in the report that you should be scared of. And considering where the markets are at, the fact that cloud is growing, the fact that Microsoft is doing so well with cloud, their cloud services, which is 60% of the business, is doing well. They're still a leader in retail. Retail numbers were not bad at all. Just a lot of good in the Amazon report. Okay, so here's Microsoft. So let's look at the initial trade that we put on. So Microsoft was a tough one. If you go back and you look at the chart, you should have gotten out. And this is a great example of, of the fact that they announced on a Wednesday, and now we're here on Friday, and Wednesday after the announcement, we had the run up initially to 555, which wouldn't have hurt us as bad on just the initial move. This is this is a 1 minute chart. We don't need to be that tight. I'm going to leave it right here because that's fine because we're here. I don't want to start messing with it. And this is the open, and then it quickly came back down within the range of our butterfly. And right about 10 o'clock, which is when I probably would have got out of the trade. If you were trying to collect the 20 cents, we put the trade on Monday. We did it for a net credit of 20 cents. I actually ended up getting 25 cents on the trade. And then you could have closed it out ahead of earnings on Wednesday and made money on the trade. You could have been just closed it out, took the risk off, made that 20 cents, which is about, I think it was 4% on our total risk. And now the market is here, and then it dropped down and it started drifting lower. And now here we're at right now at 524. So if you stayed in, you're now just going to collect. But at this point in time, we were down. As a matter of fact, I looked at the quote and I pulled it up, and this is right at 539, and this is where our market was, 540. It was trading at that moment for 40 cents. So we were down 20 cents on the trade right here. But we would have been down a lot more on this initial blip. But if you missed the market open, you didn't even notice, right? For about 15 minutes, it was a little bit crazy. But then it came back down and went back up. And then this is the point where you'd get a little nervous. You'd say to yourself, okay, I want to get out. I'm a little nervous that we might end up going through our high strike. So here's the moral to my story is we put this on a Wednesday. And I mentioned many times that if you're doing the skip strike butterflies, I like to only have 1 day remaining to expiration. But obviously, the more time, the more net credit you can probably get based off of our setup, right around a 1 standard deviation move, just beyond the expected move. That's always the way that we kind of look at them. And if this was a Thursday going into a Friday, we wouldn't have been down on this trade, right? So at that moment, right where my crosshairs were, you probably should have got out. Well, you should have got out. My rules say that if I'm at 540 after that earnings report, and usually you give stuff time to shake out. Now, if it would have just continued on up, yeah, you just were screwed anyways, because you're way above the 550 level on the upside. But right here, when it hit that price right at 540, which was your middle strike, we didn't have enough time decay. We didn't have enough volatility crunch to make the trade profitable. And you put it on for a net credit of 20 cents, and you should have taken it off for a net credit of 40 cents. But if you fell asleep, the market started to go down, and then it hung out at the perfect level almost all day long, 535, 535, 30. And as we got closer to the close, might have taken it off here on the trade, but then the market opened down. And now, if you've done it, there's no reason to take it off, because now time decay will allow you to be profitable if the market comes back to 540. Does everybody get that? This is just such a weird trade. So let's send it to the what if calculator. And yeah, this is the mic. So right now it's actually showing you inside the what if calculator at 11 a.m. on this Friday that the green line is morphed into the yellow line inside the profit and loss calculator. But usually, like with that half a day, some of the models break down anyways. But with this said, this shows you that if you got it on right now and you can close it for 3 cents, there's no reason to close it unless you need to hit the golf course or something. Because if the market does come this way, you are going to benefit before you lose. Right? If the market hits this level right here, we might be able to close this, as a matter of fact, as much as $5 if we stop right at here. So we put it on for 20 cents and we could sell it for $5 if we stopped right at 540. So if we got $1, $2, $3, that'd be fine. So there's no reason to close this trade out if you're watching the market. There's no reason to do that at this point in time. We're going to hit the precipice. Time decay is going to be large. And actually, let's look at what the at the money one would be trading for. Okay, so if the market moved 525, okay, that's perfect. There we go. Let's clear this out. If the market moved and made this in the money, right? We go this, boom, boom, and skip this one and buy this one. Right now, we'd get $2 for it. Right. So if it went so we're using today's options, and if the market went boom, we're going to 540, right? All of a sudden, snap, we're at 540. Right now, you'd be able to close this position for a net credit of $2. It's showing a net debit of 2, but you'd be flipping the script, right? This would be a sell, this would be a buy, this would be a sell, because you'd be closing the position. So if the market moved right now, you'd be able to close this out for $2. So there's no reason to close the trade, right? Right now you just say, well, heck, that'd be great if it came back and traded right back here where the chart was at. So the trade, I don't know. There was this moment right here where the trade didn't work, and that was it. And if you did get out in that moment, that's all right. There's nothing wrong with that. I normally would wait till about the 10 o'clock level before I'm going to place a trade after an earnings report. But if it does hit that strike, it does hit your middle strike on your trade, you got to get out. And that's the rule. All right. Any questions on that one? I don't see anything in this. Anybody put that trade on besides me? Just wondering. All right. So, Amazon. Doggone it. Microsoft, great earnings report, got rewarded for it. Amazon ran up with it, mainly because of the cloud services and Amazon Web Services, the perceived good. Kind of hurt the stock anyways, because it did make a good run up, and then it gave a reason to sell the stock off a little bit. Stock is down 8% at this point in time, trading at 216. We put together one day, and I actually did say you could go out to a week on this one, give it a little bit of time. I wouldn't be surprised if we're back to where we started by early next week. It's actually not a bad time to probably buy a call option if you wanted to speculate just on a dead cat bounce in Amazon. But here's the chart in Amazon. And let's go 15 minutes. And click OK. There we go. Okay, so here is the blip up that we got from Microsoft's earnings. Came back down, another blip up, but that went from 230 to 235, and then it came back and tested it and went to 236.60. And then if you just even waited to the end of the day, you're still at 235. You're still up on the trade overall. Now the stock is down, and we're down 18. But there was an opportunity to get out of the trade ahead of earnings and make a couple of bucks. So do it. I guess if you just got one lot on, maybe you ride it into earnings still, because it wasn't a huge reward, but you did definitely put it on for $5. It could sell it for $6 pretty easily. So a lot of times, if you have the opportunity to take that profit without having to go through the earnings report, and you get the bonus of what happened in Microsoft and the fact they blew out the doors, that made that Amazon trade interesting, then you go ahead and do that trade. All right. And then as far as next week is concerned and looking at trades. Actually, I should just finish the thought. I can't just talk about the good, right? So let's add the long call vertical and show that if you did the 1 day trade, it didn't pan out. You paid $500 for the trade, and now it is trading for nothing. That's simple. We put the trade on. Now, if you went out one extra week, because remember, we showed you that if you go out to the 7th or 8th, that it doesn't cost you. It costs you a dime more to go out on that trade. So on a percentage basis, it's a very small percentage to give yourself a week on the trade. I chose to do it speculative. I normally would be doing a skip strike butterfly, but we just couldn't get it to work. And this is where we ended up in the Amazon trade. All right. Any other questions? No questions so far. Okay. So next week, this is going to be real short, less than 20 minutes. Next week, I'm going to look at doing some VIX options. I do, the market's down right now, and the VIX spiked a little bit, but we're getting into August 1st. I do want, we could next week, at the end of the week, we're talking about August 8th, and might want to start thinking about doing September option contracts. Let's actually go and take a peek, because we got a few more minutes here at the VIX options. And let's look at September 17th. Okay, so here's the August expiration. This is the normal monthly expiration. Those are the only real liquid options. And then you go out to September, and the September expiration is the 17th, 47 days away. Where's the VVIX at? VVIX is at 107. So that's elevated, and the VIX is elevated. So I wouldn't want to do it today. But if we go out to this expiration, we'll have to see where the future's trading. And to see where the future is trading, you'd look at where does the call and put switch, and it's 21. So this is up a little bit too. So at 21, we're almost at zero. If we bought this call and we sold this put, we'd be at even on our trade. It's not letting me sell you. Oh, there it goes. I did 12 of them. All right, so we're going to sell this one. All right, so basically even. So this means that that's called put call parity. That's a synthetic long VIX, showing us where the future is at. If you just think about normal options, if the call is equal to the put, you would expect that to be fairly at the money strike, right? And there's a little bit of nuance in there. There's some, forward value of the stock and stuff like that. But with that said, on a short-term basis, this is showing you where the futures is at. The VIX is at 18. It made a run up, and the futures at 21. I'd really like if we could get an update on Monday. I'd love to see this get down around the 20 level. We haven't really breached the 20 level at all on the September future. So if it did, I wanted to get long it, but I think we got down to about 19 and a half on the futures. But it's hard because all I have access to is the delayed quotes at the Chicago Board Option Exchange. I don't have access to the VIX futures. So with that said, we're on that strike 21. This is where it's at. We're going to look at doing the long VIX. And if the market wasn't down today, we would consider it today. But next week, if we can get a little bit of a rally up, a little bit of a downturn in the VIX, and we could see the futures contract in September get closer to the 20 level. The VVIX is up a little bit too, which is the volatility of the options that are in the VIX index. So that's trading around 107. On the low side, I would say that would be around 80 or 90. On the high side, this thing can go to 200. But right now it's at 107, so a little bit elevated. That goes right hand in hand with the VIX options. All right, but that's what I want to do next week. I want to look at some VIX trades. We still have some earnings reports. We'll see if we can keep the streak going. I'm going to say that the Amazon trade was a losing trade, which it obviously was. So we were on a roll there for quite some time, and I'm going to take the win on Microsoft. And if you did get out and you'd lost 20 cents on the trade because you got out right at that moment, then that's a tough one. That's a tough one overall. But that is the way the trade played out. It was a good trade. It was a very good trade in Microsoft. I like that trade a lot. Well, that's it for this episode of Options Guide TV. We're going to come back next week, look at a few more earnings, and talk about a VIX trade. Thanks for stopping in. We'll see you Monday morning, 11 a.m. Eastern Time for the next edition of Options Guide TV. Thanks for tuning in.
You know how the financial world goes. Here comes the buzzkill. Please make sure to take some time to read this boring disclaimer. We will owe you one.